Well, J-Pound just flipped the script as a big old Merry Christmas to you. Yes, Merry Christmas and Happy Holidays to you from your friend J-Pow and his buddies at the Federal Reserve. That's literally what we got here. Now, we have to understand the longer-term implications of this, so I'm going to start with the longer-term implications, and then I'm going to talk about what J-Pow just said, but this is going to flip expectations. It is a big deal. Look, let's be clear. There are a lot of money market assets sitting on the sidelines. Total assets in money markets have absolutely exploded. They've exploded, as you can see by this chart right here, they've exploded because of all the massive, crazy money printing. They were somewhere right around before COVID, they were somewhere right around 4 trillions. They're sitting somewhere around 6.2-ish right now in money market funds. And that's money markets. That doesn't even count the money that's sitting in bonds ready to dive back into stocks. This, in my opinion, is the signal. Jerome Powell today, for the first time, suggested we are at or near the peak. He's basically softly trying to say, we're done. Unless something dramatically changes, the Fed is done. That is the clearest signal you could possibly get to buy treasuries from Jerome Powell. Whether you want to use that signal or not, on you, not personal advice. The 10-year treasury down 16 basis points right now. The 2-year down 25 basis points. That's great. That is a normalizing of the yield curve. And if you don't know what any of that means, it just means stonks up. It's a good thing. And Jerome Powell seems, and the Fed seem convinced that we're not actually, certainly not in a recession right now, but also not necessarily heading to a recession. Yes, could there be a recession? Yes, but Jerome Powell made it clear, we're not seeing any evidence that right now we are in a recessionary territory. Instead, what we are seeing is that all 3 levels of inflation are trending down. Goods inflation. He had a great quote. He's like, I don't know, maybe people aren't buying stuff anymore because people bought enough stuff and now they don't want more stuff. That was a quote. Anyway, goods disinflation. Housing disinflation. Core services disinflation. It's starting. And the Fed is finally waking up to realize we don't want to over-tighten. As a result, what do we have? An over 60% chance that we're going to get rate cuts in February. Boom. Number 1. Number 2, 10 years about to drop below 4%. This is very bullish for stocks. It's also bullish for bond prices. Yes. Next, what does it mean? It's probably going to start the transition. And this is the euphoric rally I talked about. We made a video about this, and I warned that this could come. If you're not joining me, by the way, every day the market is open. We talk about this every day. Totally free. We got Poverty Chat on. It's great. Everybody can join, and it's great. Every day the market is open at 5:25. We cover the market open, and you can ask your questions, whatever you want. But I made this video on December 8th called Warning, Stock Market Euphoria is Coming. There it is, Warning, Stock Market Euphoria is Coming on December 8th. And I talk about how when the Fed signals that U-turn, as soon as we hit peak, the market will probably go euphoric. Absolutely euphoric, which is fantastic because it's a way of Jerome Powell saying, look, we've done enough. We've put people through enough hell. Now, let's actually try to prop the economy up again by letting asset prices go up. Let people get richer again. Let people make more money again, and then they can keep going and buying stuff for the economy. Now, what's very interesting, which a lot of people missed, he was asked, hey man, but prices are still high. And he's like, that's true. And you know what we're doing about prices still being high? You ready for this? This was priceless. Did you catch it, what he said? What is Jerome Powell doing in response to prices being high? Well, real wages just went positive, so hopefully you'll make more money to be able to pay more. Yes, that's basically literally what he said. When he was asked about prices being high, he said, well, the good news is wages are going up. So, that is true. We just barely went positive in real wages, but it is a way of the Federal Reserve saying, hey, don't expect us to bring prices down. We are going to turn the money printer on well before we need to make sure we don't go into a recession. And when J-Pow sticks this soft landing, I'm putting a statue of the guy in my front yard. So, What else? What else did he actually say? So, economic activity expanded at a strong pace. We held rates stable. Inflation has eased over the past year. They added the phrase any as to whether or not they would raise rates at all anymore. And then, of course, in the Q&A, he suggested they're done. He suggested that housing has flattened out. We're seeing a lot of rents down across the country year over year. Certainly at least flat. So slightly down or flat, very, very common to see across the country. Does indicate he believes we are at or above peak. I think this is a great signal for real estate. There are a lot of real estate bears out there that think this real estate market's going to crash. I'm in this damn real estate market every single day. And I'll tell you, there's volatility week by week. Like one person farts in a house and all of a sudden nobody's buying it. The next week there are 20 offers on it. The real estate market has almost gotten as volatile as the stock market. It is really insane. You just don't see the candlesticks, but it's just people's emotions. It's all the same crap. Business is people. This is obviously, I mean, we talk about this in the courses. Business is people. Stocks comes down to people's emotions, and real estate comes down to people's emotions. It's very, very simple. But anyway, they actually talked about rate cuts. They had the discussion about rate cuts. One of the reasons I did not get bingo on my bingo board, which was a pisser, I was so confident we were going to get bingo. So confident. And we were so freaking close. But one of the reasons I did not get bingo is I had to put this blue X here because I wrote that they're still not talking about rate cuts. No, they actually started talking about rate cuts today. Yep, started talking about rate cuts. What a game changer. What a flip. It's been 2 years. You remember the worst Fed minutes ever? Like, who here remembers it? We covered it on this channel. Federal Reserve, the worst minutes I've ever read in my life. Those were from the December 2021 meeting. December of 2021. What the hell? Oh my gosh, it's been 2 years. Anyway, so let's go ahead and keep going here. So we've got inflation levels, the 6-month very, very low, 12-month also trending low. These are important levels to look at. It's not the month over month that matters so much. It is important that we actually end up looking at those trends. Nick T does a good job of posting the trends. We can go ahead and pull up some of these trends. Here's an example for you. This is the CPI right here. Look at that 12-month trend, that dark line right here coming down. The 6-month trend coming down. Both of them down. Both of them mentioned by Jerome Powell. Inflation expectations low and falling. Great. Didn't get any talk about oil. I was surprised by that. Or foreign deflation. Although those are other factors that are also leading inflation expectations to plummet. Wages still a little bit above trend, so still want to see a little bit of restrictiveness coming into wages, though he thinks we're already on that trend. We're at about 4% for wage growth. We want to be at 3%. 3% is where you want to be. Again, the reason you want to be at 3% is because roughly, if you want to do math to it, consumers make up roughly 70% of the economy. So if you take 3%, 3.0 times 0.7, you get about 2.1% inflation, right? That's just a quick math way to kind of look at that and fact check yourself. Unemployment rate still very low, positive developments. Recession is not our base case, not seeing signs. The S&P, or the Summary of Economic Projections, is not signaling weakness. The SEP signaled 3 rate cuts as opposed to the 2 markets were expecting the Fed was going to signal. Keep in mind, markets have been pricing in 4 rate cuts, as much as 5 recently. We were not expecting the Fed to come out and give us 3 rate cuts. Jerome Powell suggested that those at the Fed sort of incorporated the latest CPI and PPI report. And he said, we can't wait to cut rates until we get to 2% because you'd be way too late at that point, 2% inflation. So did talk about slowing quantitative tightening once they get to a level they feel comfortable. They're not sure what that level is. They do think that level will be above the level of where it used to be. This is the Federal Reserve's balance sheet. Jerome Powell mentioned we're about $3.5 trillion above where we used to be. My guess is we'll probably, honestly, if we level off at about $7 trillion, that's probably where we're going to level off. Now, why would I say we only have about $700 billion of QT to go? Why would I say that? St. Louis, Fred, let's spell correctly here today. Louis, Fred, we're going to go with Fed repo facility. Reverse repurchase agreements. Look at that. Look how much money we have left here. $823 billion. So $800 to $700 billion to go. That'll bring us to about $7 trillion of a Fed balance sheet. And I think they're done then. that's when they'll start slowing or just stop entirely. So what does this practically mean? Look, in the short term, this is fan-freaking-tastic for inflation-sensitive stocks, interest rate-sensitive stocks. This is great. In the longer term, this will eventually be very good for your energy-style stocks, your Enphase, your SolarEdge. The break-even cost on energy will come down. It should be supportive to the housing market as now you're going to get people starting to speculate. They'll be able to refinance back at a 4 or 5% mortgage next year. You're going to start getting that speculation priced in starting now. And it's one of the things that's been keeping a floor under the real estate market is not just low inventory, but people speculating that prices will stabilize, and so buy what you want now. So that's important. Now, there is a fear that there'll be a flood of housing that hits the market in the spring as interest rates start falling. I don't know if that's going to happen. Nobody knows if that's going to happen. Obviously, if there's a flood of inventory, the question will be, well, how many floods of buyers are we getting? Are we getting more buyers or not? I kind of think things will stay kind of the same and flattish, that we don't need to expect some huge rallies. Just get out there and go buy good deals, which obviously I will teach you how to buy good deals with an introduction, even in the Gold course. Gold course is a great way to get introduced to buying real estate if you'd like, so check that out, Gold course. Remember, it's $420. So check it out. Go to meetkevin.com and email us for a bundle coupon at staff@meetkevin.com. It's amazing. It includes all of the Noob vs. Pro courses, course member live streams. It includes a lot. If you want the individual courses or you want to bundle up, email us at staff@meetkevin.com. You have 3 levels here as well. You could get all the courses, the gold membership or the diamond membership, which includes following us around as we go buy real estate. And you can see what it's actually like to go buy real estate and what we actually look for in houses. And you can talk to me and ask questions. So anyway, check it out. Go to meetkevin.com if you got questions. Staff@meetkevin.com. I appreciate y'all being here. This is fan-freaking-tastic news. And make sure to join me every day the market is open at 5:25 a.m. on the Meet Kevin live channel. Thanks so much for being here. We'll see you soon. Goodbye.